Have you ever worried that someday you will go to the bank and you wouldn't be able to get your money? In this video, we will explore what is a bank run, why and how they occur, and what protections are in place to protect us against one happening. So, a bank run is where a large number of customers of a bank or a financial institution withdraw their money simultaneously, bringing the bank's solvency into question. Bank runs generally start with an economic or political event that triggers the first wave of uncertainty and doubt, causing customers to go to their bank looking to withdraw their money. This news then gets out that a large number of customers have withdrawn their money, and now people are questioning the solvency of the bank. This causes more customers to get worried, lose faith, then look to withdraw their money. This cycle continues until a point where the amount of money being withdrawn exceeds the bank's reserves, therefore causing the bank to become insolvent. Now, let's look at why and how a bank run is actually possible. The first thing to understand when looking at the possibility of a bank run is that banks do not keep much actual cash on hand in any of their branches. Generally, there is only an amount kept that is considered reasonable based on consumer need and security reasons. So, when customers looking to withdraw their money exceeds that reasonable amount, the bank just won't have that money at hand to give out. Now, we're going to look at the history of bank runs. The most historical bank run was during the Great Depression, where after the 1929 stock market crash, there was news of one bank in Tennessee that failed due to a bank run. This failure caused a string of other subsequent bank runs across the rest of the US. Also, should be noted that the role bank runs had in causing many liquidity failures during the global financial crisis of 2007, which caused many large banks like Northern Rock in the UK to be nationalised. Now, we're going to look at what protections are in place to prevent bank runs from occurring. After the banking disaster during the Great Depression, governments took many steps to reduce the risk of a bank run occurring. Notably, the establishment of the FDIC in 1933. In the modern day, there are three main methods in place to prevent a bank run. These are as follows. First, a bank can choose to shut down for a period of time where faced with a threat of a bank run, preventing people from withdrawing money in person. The second is that banks can borrow money from other institutions when they do not have the cash reserves themselves. These loans can prevent them from going bankrupt. The third is insured deposits. In the EU and the US, deposits are insured by governments to help any fear that arises to subside. To conclude this video, one of the main things to understand about bank runs is that they are generally a self-fulfilling prophecy, i.e., that the fear of insolvency at a bank is what causes there to be actually any true solvency issues. I hope you found this video helpful. Please leave a comment below if you have any questions, and if you got value from this video, I would ask you to leave a like and subscribe. Until next time, this is the Life of Finance.